You've probably scrolled past a dozen AI headlines this week alone. A new data center announced on a Tuesday, a new $100 billion commitment on a Wednesday, a new record broken by Friday. At some point, the zeros stop meaning anything. They're just background noise between videos, numbers so large your brain quietly stops trying to process them. But here's a number worth actually stopping for: $1.06 trillion. That's a conservative estimate of debt tied to the AI buildout that does not show up on any tech company's balance sheet. Not hidden illegally, not hidden secretly, hidden legally, in plain sight. Buried in footnotes almost nobody reads, structured by people who are very, very good at making enormous liabilities technically disappear, and this isn't a fringe concern anymore. The IMF has flagged it. Ratings agencies have flagged it. Lawyers who spent years untangling the 2008 crisis are looking at these filings and using two words: déjà vu. So today, we're going to answer one question properly. If AI is supposedly the biggest infrastructure project in human history, who's actually holding the bag for it? And what has to happen for that bag not to break? The playbook nobody forgot. They just renamed it to understand what's happening right now. You have to go back almost 20 years to a phrase Wall Street spent a long time trying to quietly bury: the shadow banking system. The term describes a web of lenders and investment vehicles that behave exactly like banks, borrowing money, lending money, taking on enormous risk without a single one of the rules that apply to actual banks. No deposit insurance backing them, no central bank standing behind them if things go wrong, no regulator checking their books every quarter. The tool that made this whole system work, then and now, is something called a special purpose vehicle, or SPV. Here's the plain English version of how it functions. Imagine a company needs to borrow a genuinely enormous amount of money to build something: a factory, a pipeline, a data center. But it doesn't want that debt sitting on its own books, because a mountain of new debt scares off shareholders, spooks credit rating agencies, and can trigger covenants buried in existing loan agreements. So the company creates a second, technically separate legal entity. On paper, this new entity has its own name, its own bank account, its own management structure, and, critically, its own debts. That entity, the SPV, goes out and borrows the money itself. It uses that borrowed cash to build or buy the asset the parent company actually needs. Then it leases that asset back to the parent for years, sometimes decades. The result is almost magical from an accounting perspective. The parent company gets full use of the building, the machinery, the infrastructure, everything it needed in the first place, while the debt that paid for all of it legally belongs to someone else entirely. In 2007, this machine was stuffed with subprime mortgages, sliced, repackaged, and sold to investors who barely understood what they were buying. Today, the same machine is being stuffed with data centers. The AI build-out didn't start with hidden debt. It started the boring, straightforward way, with cash. The biggest technology companies are, on paper, some of the safest borrowers on the entire planet. Rock-bottom debt-to-earnings ratios, enormous, dependable free cash flow, decades of consistent profitability behind them. So the first move in financing this build-out was the obvious one: just pay for it out of pocket. For most of the last decade, these companies plowed roughly 40 to 50 cents of every operating dollar straight back into their own businesses: new servers, new offices, new infrastructure. That was already an aggressive reinvestment rate by historical standards. Then AI spending accelerated sharply, and that ratio started climbing toward the point where almost the entire cash-generating engine of these companies is now being redirected straight into chips, servers, cooling systems, and concrete. The vault that used to comfortably fund the build-out is now being drained faster than it refills. Think about what that actually means. These are companies that used to sit on mountains of idle cash, buy back their own stock, pay dividends, and still have billions left over. Now, a growing number of them are running close to cash flow negative on a free cash flow basis once AI capital expenditure is factored in. An almost unthinkable position for companies that size just 3 or 4 years ago. Once internal cash generation stopped being enough on its own, the next stop was the public bond market, and the pace of borrowing that followed became genuinely historic. For most of the previous 5 years, the largest technology companies issued a fairly steady, modest volume of corporate bonds annually, nothing that would raise eyebrows on Wall Street. In the most recent year alone, that annual volume roughly quadrupled. And in just the first several months of this year, these same companies have already borrowed more than they did across several of the previous years combined. Tech debt has grown so large, so quickly, that it now makes up a meaningful double-digit share of all investment-grade corporate debt outstanding in the entire United States. That concentration is exactly what pushed the IMF to publicly flag the sector as a financial stability concern. Not a hypothetical, theoretical risk, but a specific named worry from an institution that doesn't usually comment on individual industries. When the domestic bond market started straining to absorb this volume, these companies didn't slow down. They went international instead, issuing debt in currencies where some of them had never borrowed a single dollar before. Multiple companies have raised tens of billions of dollars across several currencies in a single trading day, oversubscribed many times over by investors desperate for yield from a safe name. That's the moment this story stops being a simple case of big, profitable companies borrowing a lot of money and starts being something structurally different, because there is a ceiling to how much debt you can load directly onto your own balance sheet before rating agencies downgrade you, and the market starts pricing in real risk. Once that ceiling starts to feel close, the debt has to go somewhere else. And somewhere else is where this story stops being ordinary. Let's build a case study to make this concrete. Call it Project Marzipan, a stand-in for a pattern now repeating itself across the entire industry. Deal after deal, quarter after quarter. A private capital firm sets up an SPV. It puts up the majority of the equity in the new entity, commonly somewhere around 75 to 80%. The tech company that actually needs the data center takes a minority equity stake, often 20 to 25%, and signs on as the building's only tenant, guaranteeing rental income for years to come. Then the SPV goes to the bond market and raises tens of billions of dollars in investment-grade debt, sold to some of the largest asset managers and pension funds on Earth. The kind of institutional buyers hungry for a steady, predictable, long-duration yield, backed by a supposedly bulletproof tenant. That freshly raised cash builds the data center from the ground up. The tech company moves in, pays rent, and that rent stream is what pays the bondholders back, year after year, often stretching 25 years or more into the future, well beyond the useful life of most of the hardware that will actually sit inside the building. The end result is a strange kind of financial split personality. The tech company gets the building, it gets the compute, it gets its own engineers walking the halls, its own hardware bolted to the racks, full day-to-day operational control over everything inside. But because its ownership stake sits just under the accounting threshold that would legally make it the primary beneficiary of the venture, the debt that built the whole thing belongs on paper to the SPV, not to the company that will actually use the asset for the next quarter century. Buried even deeper in these filings is another layer that makes the picture stranger still: residual value guarantees. In plain English, the tech company frequently promises that if it ever walks away from the lease early and the property turns out to be worth less than an agreed floor value, it will personally cover the shortfall out of its own pocket. That means the same company gets to tell regulators and its own shareholders, "This isn't our debt. Our balance sheet is clean," while simultaneously telling the bondholders, "Don't worry, if this thing loses value after we leave, we've got you covered up to a specific dollar amount." It's the exact same underlying exposure told as two completely different stories, depending entirely on who happens to be asking the question, and there's a timing mismatch buried in nearly every one of these deals that's worth sitting with. The bonds financing these buildings frequently run for decades, sometimes 20-plus years, while the initial lease term backing them is often far shorter, resetting in smaller multi-year chunks that require active renewal. That structure means bondholders are effectively locked into a multi-decade bet on a hyper-specialized, custom-built facility engineered around one specific company's proprietary hardware for far longer than that company is actually contractually obligated to stick around. Here's what makes this genuinely different from a single risky deal. Project Marzipan-style structures aren't isolated incidents anymore. They're becoming the standard industry playbook, copied almost as soon as one version proves it can get done. Call the follow-up deal Project AlphaJor. Same basic skeleton, different building, different city, sometimes a different private capital firm running point, but the exact same 75-20-20 or 80-20 equity split, the exact same primary beneficiary accounting logic, and often the exact same handful of underwriting banks moving the paper on its own. A second deal like this wouldn't mean much. Two data points don't make a trend. What's genuinely concerning is the pattern that emerges once you count how many of these have happened in a short window. and how tightly clustered they are around the same small circle of lenders, the same small circle of private credit firms, and the same small circle of banks structuring the paperwork behind the scenes. Estimates suggest the total pile of this kind of off-balance sheet financing tied specifically to AI infrastructure has grown roughly eightfold in just the last few years. Not a gradual climb, but something closer to an explosion. Legal analysts who specialize in tracking exactly these kinds of structured deals have counted well over $100 billion moved off public balance sheets in under 2 years through this specific mechanism alone. Credit ratings agencies estimate total future lease and infrastructure commitments tied to AI approaching a full $1 trillion. And a clear majority of that sum is currently invisible on the company's primary, headline financial statements, the ones investors and journalists actually read. Some Wall Street banks now put total off-balance sheet exposure across the entire industry as high as $1.05 to $2 trillion, once every structure like this is added together across every major player. And here's the part that should genuinely make anyone nervous, regardless of how bullish they are on AI as a technology. It's the same small circle of private credit firms and megabanks structuring nearly every single one of these deals, when 5 or 6 of the largest companies on Earth are all using the same financing structure, backed by the same narrow group of lenders. The risk stops being something that can be spread out and diversified away. It becomes concentrated in a handful of institutions, all exposed to the same underlying bet, all at the same time. It's effectively the same wager placed 5 or 6 times over, dressed up in 5 or 6 different pastry names. The last 2 times a financing structure standardized this uniformly across an entire industry were telecom vendor financing in the late 1990s, which helped inflate and then pop the dot-com bubble and mortgage securitization in the mid-2000s, which we all know how that one ended. Neither of those episodes ended quietly, and neither gave much warning before it unwound. So here's how the largest infrastructure build-out in human history is actually being paid for, laid out in order. First, with cash, until the cash-generating engine itself started getting consumed by the very build-out it was funding. Second, with public bonds issued at a pace the market had genuinely never seen before until the deepest capital markets on the planet started straining to absorb the volume. And now, increasingly, through off-balance sheet vehicles where the hidden pile of debt has quietly grown larger than the debt sitting out in the open. None of this is technically a scandal. It's all disclosed in the strict legal sense if you're willing to read hundreds of pages of dense filings written in language specifically engineered so that only people paid to parse it will ever actually bother. But step back far enough, and this stops looking like a normal investment cycle in an exciting new technology. It starts looking like a bet with 4 separate legs stacked on top of each other, and every single leg has to land for the whole thing to pay off. Leg 1, revenue has to multiply, not just grow steadily. Current AI-related revenue across the industry is still a small fraction of what's being spent annually just on the build-out itself, a gap measured in the hundreds of billions of dollars. Leg 2, returns can't keep shrinking the way they have been. Early estimates of return on invested capital for this wave of infrastructure have already slid substantially from where they started, with some industry projections pointing towards single-digit returns if spending keeps accelerating at the current pace without a matching acceleration in usable revenue. Leg 3, the borrowing window has to stay open, on reasonable terms, for years to come. Analysts peg the total build-out cost through the end of the decade in the trillions of dollars, with operating cash flow across the industry covering only a portion of that figure, leaving a very large financing gap that has to be filled by debt, whether it's public and visible or private and hidden. Leg 4. The physical power grid has to actually be able to absorb all of it. Several of the largest electricity markets in the country are already running close to their price and capacity limits, well before the next wave of planned data centers even comes online, and that alone is a story big enough for its own separate breakdown. If any single one of those 4 legs buckles, the entire structure doesn't just wobble a little, because these legs are stacked rather than spread out. A failure in one tends to put immediate pressure on the other 3. None of this is secret information, hidden away in some locked vault. It's sitting in public filings, bond prospectuses, credit rating reports, and analyst notes written in dense, deliberately technical language, designed so that only the people paid to read it closely ever actually will. That's the entire reason this channel exists. Doing that reading so you don't have to, and translating it back into plain language you can actually use. If this kind of breakdown is useful to you, subscribe. Because there's a lot more sitting in these filings we haven't even gotten to yet, including exactly why the power grid problem might end up being the tightest constraint of all.